So fixed assets will be divided into fixed assets, current assets, and then we'll have current liabilities, which would give us a final balance which should be equal to our capital. In the previous balance sheet example, we just had capital as one figure. However, owners would really be interested to find out how much capital they had at the beginning of the period, how much profit they earned, if there were any drawings, and then to find out the closing period at the end, to know, like, what difference uh, what was the difference in their capital from the beginning of the period or from last year to current year. So that's why then capital we would divide it into the opening capital, balance brought down, but because this is the first year of trading, it would be cash introduced of the amount. You would add net profit for the year and you would deduct drawings from it to arrive at a closing capital balance. If if the business suffered loss, instead of adding net profit, we would subtract net loss to come up at the final balance. Now we have to make sure, as with the trial balance, that the debits or the assets plus liabilities should a balance should always equal to the capital balance. If not, then we have some issues. So this here again shows, the best way of further explains the different elements of a balance sheet. And the first would be, positioning. If the point A also mentions about long-term liabilities. Here we don't have a long-term liability, but if we were to have a long-term liability, we would place it after this line item. So we would have another column, less long-term liabilities, and if it's one figure, we'll just subtract it from here. But if there are multiple figures, we'll have a subtotal in this column, and then we'll have a balance there which we would subtract, and then we would arrive at a balance. So that is for long-term liabilities. Now, one thing that some of you might ask is, why do we not put the current assets figure there and the current liabilities figure here and then just kind of like add it up there? It's because we need to find out, if in short term, if some of the creditors, if we were to repay them, do we have money in the short term to repay them? If not, this would mean that we would have to sell our fixed assets in order to just repay our short term liabilities from our current assets. So, this is a figure 16,000 is a very important figure because it shows us how much working capital the business has, which means readily available or readily convertible cash to prepay our short term liabilities, which you would have to pay within 12 months. So, this is the concept of working capital. Now, for if you look at all other things, it shows that we do not have to write word account for each item. We would just write the name of the account rather than have an account added on to it. We talked about the division of the capital section. And then lastly, balance sheet is always as at a certain date rather than being for the year, because balance sheet and trial balance show balances as at a specific date. They show what the business owes and what the business owns at as at a particular date, whereas for trading and profit and loss account, it shows what the business traded during the year, what expenses it had for the whole year, and how much profit or loss was made for the full period rather than a specific day. So, trading and loss account heading should have the, the date as for period covering. So, trading and profit and loss account for the period 31st December, whereas balance sheet would be balance sheet as at 31st December. So, you have to be very careful with the names as well. And that's it for the balance sheet. Please do solve all the activities and we'll move on to the next chapter.